Scott, thank you very much indeed for coming to this conference. Let me ask you a question. I mean, you and your team within Barclays Capital have done a lot of research, a lot of development work over the last few years around credit modeling, credit analysis. You guys are pretty much at the forefront of what's being done out there. Do credit cycles exist?
It's a good question as well. Thanks very much to chat here at the conference in Paris. I think that there's a lot of discussion. We've had it last night at dinner and here at the conference on what's happening in credit markets generally. And there's a lot of discussion of, okay, what's caused it? A lot of discussion of subprime and all of those positions. But I think if you go back in time, and my bias is as an economist, that when we do go into recession, there usually is a different driver each time. We've had recessions where war created consumer confidence problems. We've had issues where oil prices came up. But I think in the background, well, it isn't so easy to forecast the factor that causes the recession. There is a background cycle that seems to exist in credit markets where there are systematic changes in risk. And as a bank, in especially responding to building all of the infrastructure we need for Basel II, we found the hard way after the most recent recession that we had to redesign our rating system. And we had to look hard at whatever data was available in trying to measure that systematic risk that changed and incorporate that into the way in which we did our ratings, we did our probabilities of default, and the way we manage our portfolio. So, while it's hard to predict a recession outright, it is easier to say that when times are very, very good, there is a tendency for mean reversion to go back to the average. And if things overshoot from there, it can get quite bad. As a simple example, over the last year, our point-in-time measure, which is what we think is the best measure of risk in our portfolio, as credit markets have been deteriorating, our median portfolio, PD, has gone up by about 120%, which is substantial. Whereas rating systems that do not do all of these complex adjustments to get to true point in time won't give you that signal. So if you're managing a bank and you're managing risk, you have to have a set of signals which tell you risk is changing. And some of that is definitely driven by the credit cycle.
Right. So, as an institution, I mean, what is the major lesson you've learned? What would you do differently if you could turn back the clock?
That's a good question because, again, I think there are a lot of things that banks do to manage risk. It's always important to have a real good feel for your exposures wherever they are. There are examples of institutions, without naming them, in this part of the cycle who ended up with pots of exposure in these complex subprime things that were not measurable. They were sitting in different parts of the institution. So I think, as is always the case, you have to be able to aggregate your risks. But in our case, we put some of these measures in place in a benign period because we knew we needed them when things got bad to give us the signals of risk. I think that we've done fairly well overall. I can't comment for the institution officially, but in terms of what's happened, we've suffered losses like everybody else. But the question is, can you manage those, and kind of do you know what they are?
Right. Okay. And maybe finally, what does the Scott Aguais crystal ball say? Is that 2 years, 3 years, 4 years?
It's a very good question. I know it's been discussed a lot here at the conference. Trained as an economist and looking back at previous cycles and recessions, I think that I'm quite concerned for a couple of reasons. And one of those reasons is that in most cases you have a shock to the real economy which feeds through to credit markets, and then you start taking credit losses. What we've had through all of this subprime problem is a shock to credit markets, and we are waiting now for the feed through to the real economy. Defaults have not really risen aside from the structured deals. Corporate defaults have not risen yet, and in most recessions they do. The other side that that, as an economist, I'm quite worried about is the fact that, on the one hand, we have deflation in property values, and on the other hand, we have commodity prices because of China and India and world demand and expectation of scarcity going through the roof. And if monetary policy is managed tightly to control measured inflation by the indices they use, then we're in for a period of relatively high interest rates, even as consumer confidence is eroding. And the word's been thrown around going back to the 1970s, stagflation. It's potentially a variation on that, and that is, I believe, kind of the worst nightmare of monetary authorities right now.
Okay. Scott, thank you very much for your time.
You're very welcome. Thanks, Philippe.
Thank you. Cheers.